If you're a property investor, landlord or home buyer, right now is the time to pay attention because the UK property market is going through some major changes, including tax hikes, stamp duty, but of course that's slowing price growth. So in this video, I'm going to break down those tax hikes and also investment barriers, the housing market in terms of price, but also buyer demand, and of course the landlord exodus if this continues and how it's impacting the rental market. Stay tuned. A recent survey found that over a third of property analysts believe that those tax changes that were announced in the budget in autumn 2024 are going to be a major barrier for investment this year. Now that's up by 12% compared to the year before. But the biggest concern? Well, still the threat of recession, with over 50% of businesses citing it as being the biggest issue. But just behind that, those tax restrictions, which are going to be making it challenging for investors to commit. We're talking about changes in capital gain tax, inheritance tax, and stamp duty, all of which are making the market less liquid and, let's face it, less attractive for both UK and foreign investors. There are also concerns around business rates and political instability, which isn't exactly helping confidence in the market. Interestingly, access to funding actually improved over the course of the last year, but only 16% of businesses think it's going to get easier over the course of the next 12 months. This is despite the pledge of government saying they're going to pump over £100 billion into the public sector. The solution? Well, over a third of businesses say that government needs to reform capital gain tax and stamp duty if they are going to encourage investors to come into the market. Despite this, the overall market optimism has risen by 13%, with 68% of businesses feeling positive about the year ahead. And this echoes the conversations I have on a day-to-day basis with landlords and property investment, which is cautiously optimistic. According to Stacey Eden from RSM UK, the current tax policies are actually slowing down growth, discouraging investment, and making it even harder to build the homes the UK desperately needs. While the National Planning Policy Framework is a step in the right direction, she argues that real reform in the property taxation is what's needed to unlock the long-term growth. The bottom line? Well, the UK property market is still moving, but these changes in tax policies could make it much harder for property investors to get in and stay profitable. If you invest in property in the UK, these are definitely changes you want to keep up to date. So make sure you subscribe so you don't miss any of these changes that is ever evolving. Okay, so let's talk about what's happening in the UK housing market right now. So as of January 2025, the average house price is just over £267,000, up by 1.9% compared from last year. Now, by the end of 2025, prices are expected to increase by 2.5%, but the rate at what price growth is going is slowing down. Despite this, sales activity is up, with 10% of properties selling and 11% more properties listed on the market compared to last year. This is partly driven by higher wages, retail growth, but also rising consumer confidence. But it's not all smooth sailing because where you buy does matter. Northern Ireland saw growth of 7%, whilst the Northwest saw 3% growth. And yet when we look at London and the South, it barely moved, it was just above 1%. Why? Well, the autumn 2024 budget and the rising mortgages have hit the South the hardest. And it makes sense. Properties in the South and London are going to be much more expensive when we look at the North. I mean, you get a property here, one bed, in prime London at least, will cost you an average of around about £500,000 or above. In the North, you could probably get a one-bed property for 150k. Stamp duty hikes are kicking in. From April 2025, half of homeowners will pay an extra £2,500 of stamp duty. And over 40% of first-time buyers will pay more this year moving forward than they did last year. While these increases aren't huge, they may slow house price growth as those buyers negotiate lower prices to offset these extra costs. Interestingly, there's a huge shift between flats and houses. It's one of the biggest trends in 2025. So what we can see is that flats have had a huge comeback, at least when it comes to supply. In fact, it's 14% increase this year compared to last year. However, when we look at houses, when it comes to demand, there's a 16% demand, but supply is only 5% higher, which explains why there's an increase in price when it comes to houses of 2.2%, whilst for flats, it's only 0.5%. Since the pandemic, houses have skyrocketed in value, and flats, well, they've lagged behind. If we look at this over the course of 5 years, we can see that houses are 24% up compared to 5 years ago. Well, flats, well, they're 7%. Right now, there is the biggest gap that we've seen in the course of 30 years. And if we look at houses, they're 67% more expensive compared to flats, the biggest gap that we've seen. Even though flats are more affordable, first-time buyers prefer houses over flats. In fact, in 2017, we can see that 44% of first-time buyers wanted 3-bedroom houses outside of London. That's up to 52% now. And when it comes to flats, 1 to 2 bed flats, that is down from 25% to 17%. But here's the surprising thing, or maybe not for some of you. Buying a flat is significantly cheaper than renting. Mortgage cost is just over 40% cheaper than renting when it comes to flats. However, with houses, well, it's actually mortgage cost is going to be over 20% more expensive. So why is it we're seeing a massive flood of properties hitting the market, especially when we look at London, South East and the South West? We're seeing a 12-year high in sales stock levels. And the reason? Well, there is a segment of landlords that is leaving the market and leaving quickly. And that's understandable. We've got the rising cost of taxes, regulations, red tapes, and dare I say it, there's also a segment of the region which is returning a very low yield. But overall, if we could see the articles that have come out over the course of the last few weeks, we can see that there are some great rental yields, especially when it comes to parts of the capital. It was challenging to see yields around about 4.5% 5-6 years ago. Now we can see 5 to 6%, and that is good for the south. And as I said before, there is a segment of landlords that are actually expanding their property portfolio. So the takeaway from this is that there are landlords who are expanding, making it more scalable, and so it could be more viable when it comes to tax and incorporating their properties. So there are solutions in staying in the market to make it viable and profitable. So for them, when I speak to them on a day-to-day basis, those landlords who stay in the market, they're saying, well, the more they exit the market, the better for us. If you're finding this video helpful, smash that like button. It really does motivate me in pushing more of these videos out. So let's look at the rental market very briefly. As we see that rental inflation has slowed down to its lowest point in 3.5 years. Average rent has risen by just 3% over the course of the last 12 months. Yet, if we look at what that represents over the course of the previous year, we can see that it was up by over 7%. Slowdown in that rental growth does come from the supply and demand ever so slightly balancing out. The number of available homes on the market is 11% up, whilst when we look at demand, is 17% down compared to last year. However, the market continues to be very competitive, with double-digit renters going after the same property. But that being said, affordability continues to be the issue for that rental growth. In fact, the report states that the slowing down in rental inflation has more to do with affordability than it does with the increase of supply. I mean, if we look at the course of over 3 years, we can see that rent have increased over 20%. Tenants are now paying over £3,000 more. So that's bringing the annual rent apparently to an average of around about £15,000 per year. Now, that's 15,000, I'm sure, outside of London, because in London, it's easily going to be double that. And looking ahead, rents are forecast to increase between 3 to 4% in 2025. And if you're a landlord or a renter watching this and you want to find out what the real threat is to you, make sure you watch my next video, which is about corporate landlords.